Hi everyone, welcome to Fifth Person's live webinar. My name is Rusmin, and today we're going to cover the topic on the REITs, real estate investment trusts, and how the interest rate is going to affect the REITs performance and whether they're going to make a comeback in 2025. Okay, so and that's all I'm going to slightly share with you. The basic of how actually interest rates affect the REITs. To be fair to some of you guys in this room, because there are quite a number of you guys in this room. I think we have like hundreds, a few hundreds, and so the chat this evening I think is going to get flooded. Okay, so I know some of you can't wait to ask me question, but I already prepared the short presentation for you guys. And at the same time, I also already insert some of the question that some of you guys have actually submitted before we have this live webinar. Okay, so I'm going to answer some of those questions, right? And if you did not submit any question, don't worry. Okay, you can see what other people are actually asking, right? And then after that, you see whether if I manage to answer any of your question. If not, you type in your questions, right? So I believe I'm going to answer quite a lot of your questions that you guys have in mind right now. Okay, some of you are asking whether will Trump make the REITs great again? Okay, KK. And has some of you like asking like has reached the bottom, right? And yeah, not to forget to mention Happy Chinese New Year. Okay, thanks Kim Lun. And of course the rest of you who have just tuned in, all right, Happy Chinese New Year. And I hope you have a great celebration. And those of you who are not celebrating Chinese New Year, I hope you had a fantastic week last week, all right, during your time off. So I personally just came back from Jakarta, all right? Actually, I wasn't in town during the Chinese New Year, all right? And so there was a bit of flood actually in Jakarta, okay? I hope. Happy Chinese New Year, everyone. Okay, so tonight is going to be a insightful night for a lot of you guys here. Okay, I know some of you here are our members, especially like Dividend Machines member. You have gone through the training with us on how to find quality REITs, but at the same time, you might have question about macro situation, like what's going on in the US, what Fed is doing with the interest rate. Right, so tonight is going to be the night I will try to answer some of those questions in this session. Okay, and some of you guys here are not our members. Okay, so for those of you who are our Dividend Machines member, just type me in the chat. Okay, then at least I know whether a lot of you guys here are Dividend Machine member. Okay, and if you're not a Dividend Machine member, just type not yet. Okay, I hope you join us soon. Okay. Because we're going to launch Dividend Machines intake, okay, this year intake, I think starting from next Monday, this coming Monday, basically, okay? So if you're ready to join us, okay, so Monday onwards, you can start to sign up, all right, from then on, okay? And then we will close again for the year, all right, and then open again next year. All right, so looks like quite a number of you guys here are our Dividend Machine member. So I think by now, you guys will probably know how to find quality dividend stocks, REITs, and even we also cover banks, and we cover both Singapore market and Malaysia market. Okay, so yeah, some of you here are also not yet. Okay, so that's why I say this webinar I will try to cater to everyone. I know it's going to be very difficult because some of you here are very, very experienced. You are just tuning in, see what this fella fifth person is up to, okay? And some of you here are completely a new beginner. This is like the first time investing in stock, and you are here to hear my opinions whether you can actually this is a year to invest in REIT. Okay, so I'm going to cover quite a lot of them here in tonight's session, but I can't cover everything, okay? Because we only have like an hour plus to 2 hours, right? So I can't possibly cover everything, but I'll try my best to answer all of your burning questions, especially when it comes to investing in REITs, including the ETF, because I received some of the questions about REITs ETF also. Okay, so I will cover that and I'll share with you my thoughts on it as well. Okay, so hold on to your question, okay? And then towards after I'm done, I'm probably going to take 30 minutes at least to an hour, because some of you have already submitted a question. I will answer those questions along the way as well. Okay, and any other question, I'll try to answer them towards the end. Okay, so okay. So quite a lot of you are dividend machine member, and also quite a lot of you here are not dividend machine member. Okay, all right. Okay, so let me share with you my short presentation. Okay, and before I move on, as usual, okay, what I'm going to share with you this evening is not a recommendation to buy or sell. Okay, so it's very important. Okay, because I'm going to share or talk about some of the listed REITs in Singapore, or even in Malaysia, or even in Hong Kong. Okay, they are not by any means a recommendation to buy or sell. Even though sometimes it sounds like Rusmi is recommending it, but I'm not. Okay, take it note. Okay, very very important disclaimer. That's why I want to put this up front. Okay, take a screenshot if you need to. I know none of you will read the statement here, but it's important. Okay, so just to do a quick recap on how Singapore REITs actually have been performing. So I have actually compiled all the REITs, about I think 40 of them here, and then I just track their performance over time, and you can see that from 2019, the REITs has gone up until 2020, and then there was a COVID. It hits the market very hard, and there was a sharp sell down, and largely also because there were a lot of false liquidation, because back then people were leveraging to invest in REITs, and they were liquidated because of the huge market correction, and they had, I think, some margin call, and then that actually leads to a deeper sell down. Okay, so if you bought REITs then, congratulations, right? You'll probably be sitting on a very good profit by now. Okay, I mean, we already started investing way before that in the REITs market in Singapore. So we also picked up quite a number of REITs during this time, right? Then eventually, COVID was bad actually, right? But then slowly it started to recover, and the index, the REITs market generally as a whole, started to recover alongside. Okay, until 2022, when the top of interest rate came up, right? Because of the hyperinflation that US were experiencing, because of the supply chain issue. If you still recall, during COVID, there were a lot of lockdowns, and then there were a lot of ships got stuck. Logistics was not moving, planes wasn't flying, things like that, right? So, and because of that, it disrupted the whole entire supply chain, and then it caused the spike of prices across the board, right? Raw material, shipping costs, everything goes up, right? It went up, and then at the time, there's an inflation actually in the US went up to as high as like 9%. Right, so it was really scary back then, and Fed has to come in to tame the inflation, right? So they have to bring down the inflation. Otherwise, people are going to complain, right? If the living costs are going up, all of a sudden, Fed has to do something to cool the market, right? And that's why they bring out the interest rate very quickly. And of course, because of that, the REIT prices started to come down. Okay. If you don't know how interest rate affect the REITs, don't worry, I'll explain in a while. Okay, but just to quickly recap what had happened, I think over the last 5 years. Okay, and then after the huge sell down in the market, then there was a mini correction, all right, a mini recovery. Okay, but then it quickly died off again. Right, so you get to see that the REITs index actually is still, I think, if you base on today's price, right, it's still easily 20% below their pre-COVID level, right? If you compare with their previous peak, obviously it's down close to 30%. Okay, so it's generally the whole sector, it seems like quite down. It's not doing well. And if you invest in the REITs ETF, 5 years ago in 2019, you probably just break even if you take into account of the dividends that you receive over time, right? So you'll probably be losing money. Unless you add on quite a bit of position during the sell down. And that was actually only a bit, I think lasted for a few months only, couple of months. And then that's it. If you miss that period, that's it, it's gone up. You're gone up by then, okay? So it seems like the whole sector isn't doing well, right? And now, let me explain how interest rate affect the REITs. How come REITs prices drop when interest rate goes up, right? So now, as an investor, if you invest in REITs, okay, generally you have like 40 options to choose from in Singapore. I think in Malaysia, you have close to 20 over REITs that you can actually choose to invest. Right? In Hong Kong, I think you have about more than 10 REITs you can choose from, right? Obviously, US and Australia, there are a lot more choices, but then it's way too far. And typically, we just stick to Singapore or even just Malaysia alone, right? So if you're an investor who invests in REITs, right, obviously you want the REITs to give you some form of return, right? So if you put $10,000 investing in the REITs, right, you expect them to give you a steady yield of, let's say, 5%, 6%, or 7% every year. Okay, so basically, if you put money in, the REITs will pay you distribution every year. Okay, that's what most people expect, when they invest in REITs. And we all like REITs because REITs actually give us very steady dividends, right? And that actually forms of passive income because you don't have to do anything. And every year, every quarter, or every 6 months, the REITs will pay you the dividend. And that's the beauty of investing in REITs because they're quite stable and they own commercial properties around the world. For Singapore REITs, obviously, most of the properties are going to be in Singapore. For Malaysia REITs, most of the properties are going to be in Malaysia. Okay, so that's what we all see as an investor. Okay, invest in REITs, REITs pay us dividend. That's it. But actually, if you go to the deeper level, all these REITs actually they buy or they themselves invest in physical commercial properties, right? Whether it's going to be a shopping mall or a hospital or even an office building in the CBD area of Singapore, or sometimes it could be like warehouses, right? Or it could be even data centers, right? So these are the properties that the REITs will invest. So when the REITs go IPO, right, they will raise money from you, investors, right? And then they will take the money to buy those properties, okay? And of course, when they have this package of properties that got listed, right, they don't raise everything from investors. Sometimes they take loans from the bank, right? And then, of course, the other part, they will use the investor money that they raise to make it as an equity, okay? So that's how you invest in property yourself, all right? You usually buy a property, residential property, let's say, under your name. You don't pay everything down, okay? You have maybe 20% down payment, 30% down payment, and then the rest of it you take from the bank, okay? So that's how most people invest in property, be it a company or be it under your personal name. Same thing for the REITs. So how does interest rate affect the REITs? Okay, how the interest rate affect the REITs? And the short answer is, of course, it will affect the loans, but that's not the only factor that will affect the loans. Okay, but loan is the biggest factor, right? That basically the interest rate will actually affect it because when you borrow money from the bank, you have to pay the interest rate to the bank, right? So with interest rate going up, right, obviously you affect the loan quantum, right? And you also affect the amount of money that you pay to the bank. Okay, so now let me explain to you, right? If interest goes up, all right, the REITs themselves or personally, if you take loans from the bank, and especially you're refinancing it right now versus like 3 years ago, right? Your rate is definitely going to be higher. You're going to incur more borrowing costs. You have to pay the bank more. Okay, so because of the higher borrowing costs, right, and the REITs obviously, they do have a form of rental income that they receive from the tenants. And because the cost has gone up, they obviously have to deduct the rental income. They use the rental income, they minus off the borrowing cost, which is higher. And then the proceeds will be a lot less. And then they can only pay out lower distribution back to you. Okay. And that's the reason why REITs prices tend to drop in the rising rate environment because they actually pay less or lower amount of distribution back to the unit holders. And for shareholder, obviously, if you are receiving lower distribution, some of them are not happy, they sell it, and that actually leads to selling pressure for the REITs. Okay, so that's why for the last 2 years, ever since the rates started to go up, REITs prices have come down. Of course, in between, you see some recovery, but they are quite short-lived in nature, right? Especially after the Donald Trump got elected. Actually, the whole sector recovered quite well mid of last year to third quarter of last year. And then all of a sudden, when the Trump got elected, people say, oh, that's it. I think the inflation might come back because of all the policy that Trump announced, like your tariff. it's going to be inflationary in nature. All right, it might bring back the inflation, right, and that actually caused a lot of people, a lot of investors to dump the REITs in the market, and then the share price as a whole across the board actually came back down again. Okay, so and the other thing is, of course, higher interest rate will usually cause your borrowing cost to go up, and then it will also affect your interest cover. Okay, so for those of you who are new, or you are not dividend machine member, this term is going to be new to you. If you're a dividend machine member, you know what is interest cover, right? So interest cover is basically your the REIT's ability to pay their debt using the cash flow that they receive every year. Okay, so interest cover, the higher the better. Okay, if so the lower, usually because your borrowing cost goes up and your cash flow, let's say, is still the same. If your borrowing costs go up, obviously your interest cover is going to drop. All right, so that's how interest rate will affect some of these REITs in nature. That's why in the rising rate environment, REITs prices tend to drop. But if the rate start to reverse, right, like what we are seeing late last year, there was a huge rally. Okay, let me show you here. Okay, there was a huge rally because of the rate cut. All right, and that's why the REIT prices has gone up. Okay, and then it didn't last, because the rebound was so fast, and a lot of REITs were still refinancing their loans at a higher rate, and then they start to realize that, hey, how come the DPU is still falling? Okay, so the market gotten too much ahead, right? And then it actually leads to the correction, and it got worse after Trump got elected. Okay, and that's why until today it's still down. Okay, so back to these slides again. Okay, yeah. So now in the other way around, if the interest rates started to fall, like what we've seen in the 2024, right? Obviously, there was a rally, okay, which I mentioned earlier on, because with a lower interest rate, your borrowing cost is going to be a lot cheaper, and the REITs can afford to pay out more distribution. And then some unit holders who invested during 2022, 2023, when the REIT prices were down, they were expecting that the DPU to go up, okay, because potentially with lower borrowing costs, your DPU is likely going to recover or bottom up, all right? And that's why it leads to the recovery of share price, right? And then, of course, your financial numbers, like interest cover, is going to improve, okay? Now, the big difference now, I think what we have seen in 2022, 2023, 2024, I think, especially 2022, 2023, right? We have seen the fastest rate hike in our entire history, right? So because of the hyperinflation that we experienced in 2022, the Fed actually raised the rate from almost 0% to as high as 5% within a year. Okay, this is the fastest one, because the last one that was quite fast was, I think, in 2004, right? But that actually took 2 years. Okay, this one took 1 year, right? So it was so fast that REITs, they don't have enough time to react to it, because you see, you have your rental income, which you agree with your tenants, and usually it's locked up for like 2 years, or for a retail mall, for example, or sometimes 3 years for offices in Singapore, or sometimes industrial asset could be like 4 or 5 years, that kind, right? So they can't just adjust the prices overnight, or as how fast as the rate changes, right? So because of that, their top line sort of like fixed, okay, and then your bottom line, as the loan matured, they have to refinance, and then the cost eat up. Obviously, it will eat into your distribution, right? They didn't have enough time to adjust for it. Unlike what we saw in 2004, where the market was expanding, the rental rate was going up in shopping mall and industrial rental rate, even from the office rental rate back then. The REITs, if you trace the 2004, 2005, 2006 performance, they were doing very well. They have time to adjust for it, because rates were rising a lot slower as compared to 2022, right? And that caused a big sell down, I think, in 2022, and then subsequently in 2023, right? And that was one of the fastest in the history. So you look at the Fed fund rate, I think in 2004, it has begun to fall, right? And now, and actually at the initial early year or mid of last year, a lot of people were expecting that the rate to get further cut by another 1.5% in 2025. Okay, but since Trump elected in the late of last year, now the Fed has to hold the rate. Okay, so the rate expectation of rate cut was become a lot slower as compared to uh, last year, as what people were expecting. Right, and that actually leads to another sell down in the REIT sector, and some people were actually even speculating that the rate might go up. Okay, so it's gonna be difficult to predict where the rate is heading into, but right now what we can see is that fundamentally interest rate is actually affecting the REITs financial result. Okay, it's showing up, and if you look at the first half, right, of 2024, based on last year, okay, which is first half itself, you look at out of like 36 REITs that have reported their first half. Okay, this one is compiled by Business Time, right? 29 of them reported lower distribution per unit. Okay, and most of them cited that higher borrowing costs as the main reason why their DPU dropped. Right, and why? Because by 2024, okay, those rates that were high in 2022, a lot of their loans that they borrowed in 2021, which was all-time low, right, were due for refinancing. And because they had to refinance at late 2023 or even like early 2024, they had to refinance at a higher interest rate, and that's why it eat into their DPU. Okay, so there's like some form of lagging before all these high interest rates start to show up. Okay, it take at least 2 to 3 years to really like average out. Now we are already like 2 years after the past rate hike, right? More than 2 years. So this year we're going to see a lot of them may see a more stable high financing cost, okay? Because a lot of the financing costs have gone up over the last couple of 1 year or so. Okay, so this year is likely going to be a bottom up for a lot of these REITs. But if based on full year result, a lot of them are releasing full year result now, right? You still see that the full year result DPU, a lot of them will probably be lower. Okay, but 2025 onwards, you are likely going to see things are bottoming up. Okay, there might be some pressure for some of the REITs depending on their loan maturity date. If some of them they took a longer term loans like 5 years, if they matured now, obviously they have to pay a higher interest rate. Okay, so their financing costs will continue to rise. Okay, but I believe it will be at a much slower rate. Okay, so again, it is case by case basis, right? But generally, this is how I will explain to you how the interest rate actually affect the REITs. And loan or interest borrowing costs or even interest covers are not the only factor that will get affected by loans or by the higher interest rate. There are also other factors which the higher rate will also affect the equity itself. Okay, so if you look at the equity, all right, how does it affect? How does interest rate affect the equity or the net asset value? Okay, which is what we always call, right? I mean, if you are dividend machine members, all right, I talk about NAV, which is a figure that we always look at. Some people call it the intrinsic value, okay, but I generally don't rely too much on it, okay. But how does it affect the NAV of the REITs? Okay, so basically in the higher rate environment, right, usually the property prices will start to drop. Okay, why? Okay, because now if you look at US, right, you have US Treasury yield at about 5% at one stage. Okay, investor will start to question, right? Now you have a commercial property that gives you 5%, which has risk, okay, versus a US government bond yield that gives you 5%. Which one do you choose? Obviously, a lot of them will go for US Treasury yield, right? Because one is AAA rated or AA rated, and it's very safe, guaranteed by US government, versus a commercial property market, we can go up and down, right? And because of that, some people will dump their commercial asset, and that's commercial asset, and leads to the falling prices of commercial properties, right, in the rising rate environment. Okay, and usually we call it the cap rate expansions. And when the property prices, it start to fall, the REITs themselves, of course, they invest in all these properties, they will start to report lower valuation across their property. Okay, so of course this is in theory, okay, but in actual context, you may not see property prices collapsing because of the higher rate environment. It still depends on the supply and demand dynamics of the properties that we are in. Okay, so for example, Singapore, right? Singapore, you don't see office prices in Singapore falling. You don't see residential properties in Singapore falling, right? Because of the higher rate. In fact, it has gone up, right, over the last couple of years or even 3 years. And the reason is because there's a shortage, right? Residential, there was a shortage, and there was Why there was a shortage? Because of the pandemic, and it disrupted the supply, right? And that caused the construction delay and stuff like that. Okay, so that actually leads to a huge demand. Okay, so for sectors like office in the US, we are seeing a falling property prices because work from home. Right, the demand for office is not a lot weaker. All right, after the COVID, and at the same time, there was tons of supply, right, in the US office market area, right, and that actually leads to falling prices of commercial properties in the US. Okay, so this is what we are seeing on the ground. Okay, but in theory, they usually say that higher interest rate will cause the cap rate to expand, and in order for cap rate to expand, obviously your property prices have to drop. Okay, cap rate is equivalent to property yield. Okay, for those of you who know the property yield better. Okay, and that obviously, if your property prices drop and your loan is still the same, obviously the ones that get affected is your net asset value. Okay, so you see some REITs reported lower net asset value because their property prices drop, right? So they reported lower NAV. And because of that, when investors start to see, oh no, their NAV is dropping, their DPU is dropping, of course, prices will drop. Okay, and then it also causes their gearing ratio to go up, because if your property valuations are lower and your loan quantum is still the same, right, your gearing ratio is going to go up. Okay, and if the rates start to cut, obviously the market start to turn more bullish, because now people are going to pull out their money from US Treasury or Singapore government bond. They're going to invest in property because it gives them a better yield. And that actually leads to property prices going up, and the cap rate started to contract, okay, which is the rental yield started to become lower, in other words, right? And property prices will go up, right? NAV will also go up, okay, because your loan is still the same. So your NAV will go up, which brought up by your higher property valuation, okay? And then your gearing ratio will start to improve, okay, because your property prices go up, your loan quantity is still the same, your gearing level will drop. Okay, if all this sounds too technical to you, okay, this is the best simplified version that I can do it in this session. If it's still too technical, go and read out a bit, all right? And if you are a Dividend Mention member, just go and do a review on it, okay? Because I explain a lot more details in the video lessons. Okay, but this is just in general theory that I want to explain to you guys, right? So now, because we are in the high rate environment, obviously, most of the REITs will fall under this category, okay? And the trend will reverse if we start to see the rate dropping again, okay? So the rate has started to drop last year, and there was a recovery in the whole sector until Trump got elected, right? So that started to pause. Everything just put into the halt, because we are not sure whether the rate is going to go up, go down. Everyone is just speculating where the interest rate is going to be, right? But right now, I think what you want to do as an investor is, of course, avoid investing in REITs that have high gearing ratio, okay? Because if you have a high borrowings, right, this REIT generally don't withstand well in the rising rate environment, or in the environment where rate is likely going to stay high for a longer period of time, okay? So how do we know which REITs have high gearing ratio or low gearing ratio? Obviously, you can go to the REITs annual report and find out those information, or you can simply go to our website, where we actually compile a list of REITs for you, okay? And these are all free, right? And you can just go to our website, sreit.fifthperson.com, okay? And then once you're at our website, okay, you can see that you have Singapore REITs, Malaysia REITs, we have even Hong Kong REITs as well that we actually compile for you. And here, I think you get to see that we only list the REITs here. We don't list business trusts. Okay, so you can go down there and check. And we update this every day. Okay, so not live okay, because we are not connected to SGX, so we can't give you live information. But you don't need live information, right? Unless you are trading, you can just go to your brokerage account to see the live prices. But most of the cases, the prices won't differ that much, right? So you get to see the yield that you could get if you invest in one particular REIT. Doesn't mean high yield is good, okay? Sometimes high yield could be like, a disaster that is waiting to happen, okay? And we also gives you price to book based on their latest annual report or full year result, latest DPU, latest NAV. Based on the full year result, okay, and property yield, which if you do not know, you can go and read that. Basically, it's a cap rate also. Okay, you can treat it as a cap rate, and then the gearing ratio. Okay, so here we actually highlighted the gearing ratio, and you get to see that which REITs have higher gearing ratio. All right, so you see EC World REITs. Avoid. Right, when you have too much debt in a rising rate environment or high rate environment, they're not going to do well. Okay, if you look at their performance, I think it's going to be horrible. Right, so let's EC World REIT share price. Let's see. I mean, I don't follow these REITs because it's the REITs that I will personally avoid. So you see, it's doing horrible. Let me zoom in for you guys. Right, so I think barely surviving. It used to be like 80 cents, So yeah, so I think this one exposed, I think, pretty much in the China shopping mall area, all right, and they also China property market is going through a crisis. That's also one of the main factor why it has come down so much, right? And then you see elite commercial REITs. Okay, so note that the way we calculate the gearing ratio here, we are a lot more conservative. Okay, we are not using a standard gearing ratio that the REITs will give you. We actually include the perpetual security, okay, which is important because a lot of REITs don't see this perpetual as a borrowing. Perpetual is basically an instrument that the REITs raise from the public. It's just that they have no obligation to pay back, right? I mean, they can pay back 10 years later, 20 years later, right? It's good for them because they're not like typical loan where you have to pay back every 3 years or every 5 years or you have to refinance it, right? Perpetual will literally give them unlimited time, right, before they can redeem it. So that alone, to me, is a debt, but accounting-wise, they don't treat it as a debt because they classify it under equity. Okay, so all this sounds a little bit technical. Okay, so bear with me because I have to explain it to you. And yeah, so we include the perpetual securities here. That's why the numbers looks a lot higher. So if you, for example, you look at the land lease commercial, right? Okay, I show you land lease commercial. So I have a lot of questions. People ask, oh, what do you think about land lease global? They own 313 Somerset. I think they also own Parkway Parade. Yeah, so sounds like a good REIT, right? Yeah, I think they own good quality malls, right? But I always tell them I'm not comfortable having them gearing ratio of 50%. Okay, so it's a little bit too high for me. And of course, if you go to the REITs annual report, the Land Lease Global, they will tell you that their gearing ratio is only 40.9%. Okay, technically they are correct, right? But because they did not include the perpetual security, which they have in their book. Okay, so we do include that in your the numbers over here. Okay, yeah, we don't have the interest cover here. Okay. Maybe you can consider it in the future. Right, so this is actually we built it many years ago already, and we have been like maintaining it, all right, every day, every trading days. Okay, so we keep it updated, and if there's a new REITs get listed, we actually put them in, right? Yeah, so and then Lipo, wow, you see crazy 61 Manulife. This one because property prices falling, so this is a double blow. You see, you have like interest cost going up, rental triple blow, rental income coming down, and then what else? What is the other one? Property prices drop, right? That caused the gearing ratio to go up, falling income, and then rising costs, right? Triple blow for Manulife. Okay, so yeah, so just avoid those overly leveraged REITs. Okay, that's what I can share with you. Okay, and now back to here. Now, if you recently, some of you may have like seen this news, right? Lipo Mall could fail to meet its minimum interest coverage ratio for FY 2024. Okay, and you'll be surprised how low their interest coverage is. Okay, and this is after the MAS revision, because previously MAS require some of these REITs to have interest coverage ratio of like at least 2.5, right, times if they want to buff up their gearing ratio to 50%, right? And they could not meet the criteria. They could not meet the criteria. So MAS has to revise this, right? Because of the higher rate environment. Okay, they actually change the requirement, right, from 2.5 times to 1.5 times now. So they even lower the level of interest coverage ratio, right? Because otherwise some of these REITs will really like breach the rules, right? It's not their fault, but because of the high rate environment is beyond our control, and MNs just want to make sure that the REITs would not suffer any collateral damage or breach the bank covenants, which would be a big problem for a lot of their investors. Yeah, so they had to change that to lower to 1.5 times of interest coverage ratio. Okay, and I think this is just to make sure that some of these REITs don't go bust. But I think personally, as an investor, 1.5 times is crazy. It's way too low. Okay, minimally, if you're dividend investors, dividend machines members, I told you guys that we look at minimum at least 3 times interest coverage ratio. Right? Otherwise, it could be a big problem. Okay, so I think for Lipomo, they are like how many times? I think they are like where was it? I think it was like 1 point below 2, okay? And they would fail that criteria, okay? So this REITs, it's financially very, very shaky. And I've been like warning our members, don't bother at this REIT. And on top of that, they have some of the loans, I think, in foreign currency. And with rupiah continue to weaken, it's like quadruple blow, okay? And their rental income dropping, their assets is falling, and then currency weaken against Sing dollar, which is their reporting currency. And yeah, so multiple blow, right? So I don't think this REIT will survive because it's been in the downtime for a long time, okay? Yeah, so yeah, there are some good questions like Cam asked, if a purchase security don't have the obligation to repay, what would be the risk to the REITs then, right? Obviously, they still need to pay the interest, right, to the perpetual securities, and one day they have to pay, right? It's just that when I think they do agree with the investor every 5 years, I think they have to buff up the interest rate if they don't pay. That was, I think, some of the terms and conditions that they may have in place. Okay, so but to me, it's when you hide your borrowings under perpetual securities, I will still count it as a gearing ratio. Okay, it's just that they can bypass MAS gearing ratio, right? They won't be treated as like breaching of gearing ratio 50%. Yeah. So this is something where, and as an investor, you always want to be staying on the safe side. Okay. So I mean, a lot of you guys have good question there, right? And what is the ideal gearing ratio? So for our dividend mention member, I always tell them that you need to keep at least 40% or below. Okay. So, but gearing ratio, interest coverage ratio are not the ratio that you just looked at, and then you choose your REITs. Okay. I just want to warn you guys, especially if you are non-dividend mention member. You don't choose a REIT based on financial metrics alone. Okay, you know that those dividend mention members know that, right? There are qualitative aspects that we look at as well. Okay, so yeah, so then there are also other questions that you guys ask. Okay, so any impact when interest rate remains stagnant? Okay, so now the chances are very high that interest rate is likely to stay the same for I think a few months, right? Because Fed has to monitor the inflation rate, whether there's going to be any big spike, okay, coming from the Trump tariff. Okay, recently he has already fired the tariff against Mexico, Canada, and also China. And just yesterday, I think he make a pause with Canada and Mexico for a month, right, and under negotiation. So it's his way of like getting some of these countries to do more business with the US, right? If not tariff you, right? So that is just Trump method lah. Okay. And today I think China or yesterday China retaliated with a few things, right? So this trade war will be going and continue to grow. I think it's going to intensify. So interest rate direction is very hard to predict. Okay. But what if, right, it stay the same for the rest of the year? Okay. Then obviously REITs will have less pressure on their financing costs because they are already experiencing it for the last 1.5 years or 2 years with higher financing costs. Okay, so now if the interest rate is going to stay the same, some of them will still continue to see higher financing costs because they have loans they took up during like COVID, when the rate was actually close to zero, or prior to that, okay, when the rate is like 2 to 3%. Now it's like 4%, right? 4%. So it's still slightly higher. So you will see DPU impact will not be as bad as compared to last year. or even last year. So last year was quite bad because it's a full year blown impact to a lot of these REITs, right? So and if it continue to drop, okay, which some of the people are actually expecting or projecting to drop another 0.5% to 1%, then it will be a key, it will be positive for REITs as a whole, okay? And if there's no reduction in interest rate for the long term, how do you think the REITs will perform, okay? So this is basically, I think the REITs should either stay the same, if not, the prices will see a better recovery, at least 10 or 20%, okay? Because some of the quality REITs, if you invest in them, they are able to raise the rental rate. Okay, like I said, it's supply and demand dynamic, right? If it's very healthy, they can continue to raise. These that were renewed, they can tell the tenant, sorry, my cost is going up. I have to raise the rental rate by 10%, 20%. If you don't want, bye-bye. I have tenants on the queue or waiting list, right? They'll be happy to take over. Okay, so yeah, so some of if you invest in good quality REITs, right, the landlord have the bargaining power, all right? So that will be continue to benefit those quality REITs. Those lousy REITs with lousy fundamentals, they will suffer lower DPU and then the rental continue to drop. Obviously, they will not do well. Okay, so it depends on what REITs you're talking about. Okay, so is there any situation where the REITs will still thrive in a high rate environment? Okay, obviously REITs will not do well in a high rate environment. Okay, we have seen that in the 5% mark. A lot of REITs were not doing well. Okay, and if you stay at 5% for a long time, obviously not many REITs will survive, or a lot of them will continue to report lower DPU because high interest rate environment generally are not very suitable for invest in property generally, right? Because the financing cost is expensive and people will think twice. Right? If you are investing in property that gives you 5% and your borrowing cost is 5% or even higher, then obviously you'll be losing money and then that will stop the flow of money into the area. The property prices will drop, okay? And vice versa, okay? So now, but with the interest rate dropping or stabilizing, all right, let's say you continue to drop to 4 or below 4%, I think REITs still will do decent. Okay, those good quality one. Okay, if it's dropped back to 1%, which I don't think is going to happen anytime soon, unless a black swan event happens like what we saw with 2020 COVID, 0809 crisis. Okay, then we might see REITs outshine the rest of the sector. Okay, because financing cost is so cheap, everybody will just get into the REITs, and on top of that, a lot of property investors will actually got into the property market, okay, because of the low rate environment. Okay, so now if you look at the past performance, you get to see that REITs generally do very well in the low rate environment. Okay, and that's of course because of the global financial crisis, a huge reset at the time, they were doing very well, right? And then even in the rising rate environment, they still did pretty well, all right? So if it's a slow and steady rising environment, the REITs have time to adjust, renegotiate their rent with the tenant. Usually the REITs will still turn up well, okay? So 3%, 2-3%, they're generally still okay. But all of a sudden gone up so big, of course, they don't have time to react. The REIT prices come down. Now with the rate coming down, the prices of the REITs obviously now is consolidating, okay, after the sharp recovery last year, which didn't last, didn't last long enough, okay. So today, of course, we still see REIT prices still quite depressed, okay, because of uncertainties towards the rate cut. Okay, so I'm going through some of the questions that you guys submitted. Okay, I didn't put the name because I received over 200 questions, so I just. My team compile all those questions, categorize them, right, and then just pick some of the questions that I think has been repeatedly asked. So I show it now, okay. And a lot of you guys have the same question, right? Some of the questions that you guys type, I know I'm going to answer some of them, so I'm not going to reply you, okay, because I can't look at the chat and also look at the slide at the same time, okay. So like I said, don't post your question first, sit down, and if you have a question, you can type them in the notes. You can fire the question later, all right? If I didn't answer them. If I answer them, then you can just delete the question that you may have, okay? So it is unlikely interest rate will return to the previous low of 1%, like pre-COVID level. How would the REITs perform in the next 10 years in this new interest rate environment with interest rate hovering above 1%, okay? So like I said previously, right, if rate stays at 2.5, 3%, which is the ideal rate for Fed to maintain, because everybody wants to see inflation at 2%. Right now, the inflation rate in the US is about 3.4, 3.2% there about, right? And they want it to continue to come down. And if it continue to come down, the rate will continue to come down. So the ideal range is 2%. So under the 2% normal operating environment, REITs will do well. Okay, no doubt, right? Because we have seen it, even in the high rate environment like what we saw in 2006, 2007, REITs did pretty well. Okay, and that was also because economy was booming at the time. Okay, versus last couple of years high inflation. Right, that time don't have high inflation, okay. So now we got high inflation, right? So I think generally, if the rate stay above 2-3%, the REITs will still do pretty well. So hopefully we'll see further rate cut this year. I'm expecting another 0.5% cut, right, by the end of the year. Ideally, 1% will be the best. Okay, so if not, stay invested in good quality REITs. Those good quality REITs should be able to continue to do well. Okay, because their cost of debt also have gone up, right? The good one, I think their cost of debt already 3.9, 4%. Okay, so they already get used to high rate environment. It's just it will be harder for them to buy new property because the financing cost is high. So if you don't come across undervalued properties, it's hard for them to really buy and expand. Okay, as the golden period of investing in REITs pass, okay, interest rates stay higher than in the last decade, I think actually this is one of the best time to invest in REITs. Okay, because I will tell you why. The valuation is at all-time low. I won't say all-time low, near the low range, which is one of the good time to park your money, because you don't want to wait until the interest rates start to get lowered, all right? And by the time interest rates start to drop to 2%, REIT prices won't be where it is today. Okay, so you have to look at 3 years, 5 years horizon if you're investing in REITs. Okay, don't get scared. I don't know where the interest is going to be, so REIT prices is going to be very volatile this year, which I think is going to be the case, right? You have to look at it from 3 years, 5 years angle point of view. Okay, and whether the rate can hit that ideal 2% inflation rate, right, which you're going to bring down the interest rate further. Okay, so I don't think so. Basically, the golden period is reaching now. Okay, not over. Okay, and have the interest rate peak for S-REITs? This is a lot of you ask me the same question about interest rate. I think more or less it's peak, but actually last year, if you ask me, I say I'll tell you it's peak, right? And then the rate started to drop, right? And then now we are at a consolidation phase, right? Because everybody is watching the inflation number. The job market is very healthy in the US. So it really depends on the tariff that Trump is going to impose with the rest of the country he's targeting at, right? Mexico, China, US, even Europe, right? So it really depends on how you're going to play out the situation, okay? But I don't expect anything surprising, right, this year, okay? Hopefully, what I'm telling you is that the rate, I think, is to continue to drop, okay? And what is the probability of interest rate cut in 2025? I think the chances are very high that there will going to be further rate cut, at least 0.25 to 0.5% by end of the year. Okay, if by middle of this year, if inflation didn't move that much, or oil prices didn't move that much, raw material prices didn't move that much, shipping costs didn't, if you see student prices also didn't move that much, I think chances are very high that I think we're going to see further rate cut. Okay, so but I can't predict the rate. Okay, I can only share with you my opinion. I could be wrong. Okay, and based on what the expert, the economists, okay, these are people who have PhD, they study finance for their whole life, and then they look at the market, they look at all the complicated, sophisticated indicator. They come up with this projection, right? So, and my take is also based on their projection, okay, because I'm not smart enough to predict where the rate is going to be, okay. So if you look at the rate, okay, this was the last year September projection. Okay, a lot of people were expecting lower rate cut, closer to 3%, right? But because of the Trump policy, now the projection is actually a lot lower. So I think by the end of the year, people are expecting that the rate to drop below 4%. Okay, if it ever drop below 4%, good news for the REIT, right? Because financing costs is not a pressure, it's actually stabilizing and it's also falling for some of the REITs that already have refinanced their loan at a higher rate. Okay, so this is based on latest projection, and if 2027 come true, we are looking at like 3.5% to 3%. Okay, which is the ideal range for a lot of investors, right? People generally don't want to see interest rate at such a high rate like now at 4.2, 4.3%. Okay, so again, the number that you have to monitor very closely is going to be the inflation. Okay, so right now the inflation is about 3%, right? So this is the number that I think the Fed is watching very closely and including many other metrics. Okay, but this one is something that they watch very closely because it affects everybody, especially Americans, right? So this will determine whether if this one go back up again, interest rate going to go up for sure. Okay, so the next question is, what is the direction of the US interest rate with Trump imposing of tariff? Okay, it's anyone's guess. Okay, so right now he seems to be going quite slow with his tariff. I think now it's just 10% China. Mexico and Canada are still under negotiation. So it could get worse over time. Okay, if it get worse over time, obviously you have to expect the rate cut is even less by the end of the year, or if not, stay the same. Okay, if it get worse until like they are like going to cut the relationship, stop doing the trade, then obviously it might go up. Okay, because the prices that consumer have to pay will go up. Okay, so so the other question. Okay, like I said, I'm going to give priority to those who submitted question. Okay, but I'm not going to neglect some of the questions that you guys have also. KK said MAS new interest coverage ratio definition includes perpetual security. Is that so? Okay, I have not gone into the papers yet. But if it does include perpetual, then that will be good, right? Because it will standardize the way how REITs actually report their gearing ratio. Because some REITs still, like Lendlease, for example, they still report their gearing ratio as 40.8% or 40.9%. Okay, I can't confirm that, KK, but if it's true, let me know. Okay. I have not gone into that actually. I just saw a statement on it, so I thought that it would be still the same approach. So what will happen to the REITs when the inflation spikes again in 2025? Will the REIT stock prices be lower than the current prices? The answer is yes. REIT prices will be lower if inflation spikes again. Okay, that's something that you need to be prepared. Okay, so if you are looking at REITs, right, the way you approach it is going to be, right, first thing first, find quality REITs. They are financially very strong, right? And then you stay invested with them. If you're happy with the yield that you're going to get from the REITs, let's say 5%, right? If the REITs is not going to cut the 5%, all right, stay invested. Don't panic, even if the prices drop. If let's say the prices drop by 10%, now your yield is going to be 5.5%, and you still have capital. You can consider topping up more, because if you buy more, right, it's going to be yield accretive. Okay, so it's a term that we use for our dividend machine members, right? Yield accretive, right? Because now you can push up your yield on your investment portfolio higher, so you can add on more. Okay, don't panic because prices drop. I lost 10% of my money in the stock market. If you don't sell it, you don't lose money. Okay, so remember, don't panic whenever REITs prices drop. In fact, if you have money to top up and if you have quality REITs to invest, you should do it. Okay, so and then what if the rate cut don't occur as expected, and instead might even start to see the rate hike? Okay, what will your plan be? Okay, so basically the question is the same, right? So I just shared with you my answer, right? Stay invested in good quality REITs and top up if it's necessary. Okay, if there's a big sell down, but even better, all right, it's time to fire your bullets at all costs. Okay, if there's another 2020 sell down or 0809 kind of crisis, you should be firing because it's the best time. Okay, now is the better time to invest. I wouldn't say the best time. Okay, I'll show you the valuation later. Okay, irregardless of the interest rate environment, do REITs still continue to give decent dividend? Can we always keep REITs as a capital preservation in our portfolio? Okay, and actually, REITs is an instrument that not only is going to preserve your capital, right, but it's also going to give you stable dividend, provided you know how to pick the right REITs. Okay, so that is actually very, very important, right? So it depends on what REITs. Some REITs destroy your capital, Lipomo, for example, EC World REITs. If you invest in those REITs, Sabana, right, it will destroy your capital, right? Some, if you invest in good one, Parkway Life, okay, you will preserve your capital. Not only preserve, you grow your capital, right? I mean, we invested a long time ago, 10 years ago. I think today is still like, it give us like more than double, okay? So depends on what type of REITs that you invest, okay? So this question, it really depends, right? Can REITs still be part of the retirement portfolio together with other dividend-paying blue chip stocks in Singapore or even Malaysia or even Hong Kong? The answer is yes. Okay. In fact, I think it should be everyone's portfolio. But of course, I would encourage you to put your money in the stock. If you don't get yourself educated on how to invest for dividend stock, because if you are someone who have no investment knowledge, if you come to the market and you just buy and invest in REITs without understanding how to invest properly, you might panic when the market sell down. Okay. Our dividend machine member, and on those of you, I have repeated many times, right? Crisis is a time to buy, not panic, right? And we grill you, we teach you, and a lot of time, during crisis, I see a lot of you guys are well trained because you know that crisis is a time to buy. But if you're not well trained, someone who have like no idea about investing, when the crisis comes, people panic, which is very normal. Okay, so for people who don't want to get themselves trained or how to invest, right? I generally don't recommend them to put REITs or even blue chip stock or even stocks in their portfolio because they don't know what to do when the market crash. Okay, that's what causes people to lose money in the stock market because they don't know what to do. Okay, that's why I always think that people who, even if you invest in purely ETF and they are not educated to learn how to invest, learn how to manage your emotion, right? Don't learn how to see opportunity in the stock market. I would not even encourage because not every ETF investor, even though they say, oh, ETF safe, but crisis come and tell you that some people panic also, even if you're an ETF investor. That's why the key thing here is that you need to learn really how to invest. Okay, so now we just released a video today. We talk about the performance of the REITs in Singapore, Malaysia, and even Hong Kong. It just came out on our YouTube. Okay, watch it after today's live webinar or even tomorrow on the way to work or whatever. Okay, I tabulated the performance of REITs. Okay, you get to see that some of the REITs perform very well, some of the REITs didn't do so well. All right, so these are the bottom 5, the top 5, top 10. Right, so you get to see that if you pick the right one, okay, generally your portfolio will do pretty well. Okay, not only you preserve your capital, but you grow your capital, you grow your dividend yield as well. Okay, go and watch it. Okay, I'm not going to repeat here because it's repetitive, but not every REITs, quality REITs will be good REITs. Okay, you need to monitor them once a year. For example, First REITs used to be a good REITs. It's the top performance REITs. I know when I started tracking the performance of REITs since 2014 or 2015, right? In the end, what happened? Share price crash. Right? So there were a lot of telltale signs why First REITs going to went bust. Okay, so those dividend machine members who attended 2016, 2017, 2018, I have told them First REITs is not sustainable. Even though they have been growing their DPU every year, there were some red flags. Okay, with the way they structure their agreement with sponsor. Okay, and I talk about it in the dividend machine. Right, so I don't talk about it here, but you need to really be able to tell a good one versus a lousy one. Okay, this is very important, right? So yeah, and then Malaysia also, I also compile it. Okay, again, go and watch the portfolio. Okay, so whether you are an investor in Singapore or Malaysia, the answer is that REITs is one of the good instruments that you should put into your investment portfolio if you are building passive income. Okay, and you should not put everything in the REITs also. If you have 100,000 or if you have like 500,000 that you are planning for your retirement, you should not put everything there. Okay, because I have a retiree who came to me with a 800,000 portfolio and he dumped everything in REITs, and that was I think in 2018. I think right? And I asked him, how come you invest everything in REITs? And he told me, oh, because it pays a good yield, right? Where can you get 6%, 7% yield, right? Other than REITs. I say, yeah, you still can. Just that I wouldn't encourage you to invest everything in REITs because REITs alone is really like uh, is considered very interest sensitive to interest rate, right? So that you have seen that for the last 2-3 years. If the rate goes up, interest rate, a lot of risk prices will come down. Okay, and then you see your whole portfolio down. But of course, if you invest in good REITs, they will continue to stay giving you good dividend yield, right? But generally, I don't encourage. Maximum that you can go is like 50% of your portfolio. The rest, the other 50%, you should invest in like blue chips dividend stocks, which can gives you slightly lower yield but more stable. Can grow the dividend over time. Okay, all right. So yeah, don't put 100% in REITs. Even within the REITs itself, there are subsector of the REITs. Okay, which I will cover later briefly. I can't go through with you too much. Okay, you see now that's answering your question already take an hour, and I still have a lot of things to cover, and I have not answered a lot of your question that you guys type in there. So some of you asking, can we buy S3 ETF? Yeah, I have that question here also. Okay, so Krishna, just hold on for a while. Yeah, so now if you look at the REITs index as of now, it's still quite depressed, lah. Okay, but how do I know it's depressed? Don't just look at the index alone, right? It's this index actually consists of like the 40 REITs in Singapore. Okay, I have to look at the valuation of all the REITs in Singapore. So what we do is we actually compile all of them. We track their valuation. And then the metrics that we teach, I think in dividend machine is of course based on price to book. Okay, so I basically lump every REITs that are listed in Singapore, and then we check their book value. Okay, basically their price versus their book, and then we consolidate them, and then this is the price to book ratio for Singapore REITs. Okay, so it kind of like gives you an idea whether REITs generally as a sector, is it attractive now or is it expensive? Okay, so if you based on the chart that I plotted here, okay, yeah, so this is the number that you're going to see, the chart that you're going to see, right? So you get to have a very good idea that, okay, so the blue line here is the average, right? And then the purple one is like -1 standard deviation, which means that the way you can interpret it is undervalued, okay? And then yellow one is like overvalued. Okay, every time the black color line reaches blue, then it's a fair value market lah. Okay, generally things are not expensive, the REITs are not too cheap, not too expensive. But if it's like at the yellow side, like what we have seen in 2021, late 2019, or even above that, all right, which is I draw it as -2 SD. Right? Generally things are very expensive, which is a good time to sell. Okay, and if it's at the green line, okay, this is where I classify as super undervalued. Okay, so this is a time where you are all in. Okay, as in based on the allocation that you have lah. Okay, so that happened in 2020. That's why at the start of this presentation I shared with you that 2020 we bought quite a bit, because based on this chart I was like, oh wow, a lot of REITs were heavily sold down. And then that was the time we were picking up, busily buying REITs, and yeah, so today, a lot of REITs are in greens, right? Even though you see the whole index came down, right? Our REITs investments are making money, right? And that's why the key thing here is you must know when to buy and when to sell, okay? Not only you need to know how to find good quality REITs, but you also need to know when to buy and when to sell. That is the most important thing. You need to there's no point in buying a quality REITs at the top of the market because you're not going to get good return out of it, okay? So you might still lose money even if you invest in good quality REITs and at the wrong time, right? So this chart is very, very important, okay? And now, do you guys want to receive this updated chart every month? If you want, type yes, okay? Because right now, we only show it every time when we have a live presentation or like or with a dividend machine member like live webinar, okay? So this chart, usually we only do it on the live webinar, okay? Or even with our professional members. Yeah, so a lot of you want, okay? But caveat, okay? I think I'm going to provide this chart, okay, for the dividend machine member, okay? The reason is because dividend machine members already know how to use this chart, how to find quality REITs, right? And this chart will help them when is the best time to buy and sell. Okay, and that also doesn't mean that this chart is low. Doesn't mean that this chart is low now. All the REITs can be buy. No, okay. You still have to go to the respective REITs. Okay, so I think we with the launch of 2025, the dividend machine course, I think we're going to put this data into the website, and you guys can check it under dividend machine, the valuation tab. It's not there right now. I actually thought of it today, and I thought that our dividend machine members should have this. Okay, and then you guys can always log in and check where are we in the market cycle for REITs in general. Okay, so we will give it to you. Okay, if you are already our existing member, it's free. Okay, so again, you have unlimited updates in terms of contents, the data. All right, so we will give it to you. Okay, so those of you who joined us since 2015, 2016, 2017, 2018, yeah, you will still get all this, all right, without additional charge. Okay, if you have not joined, time to consider. Okay, but it's not open yet. Okay, it's not open yet. Next Monday, this coming Monday. Okay, you're gonna get the invitation from your email, so do watch out for that email. Right, so when we drop below -2, send us a red alert. Yeah, KK, can. All right. Can we also have the same chart for SG Bank? SG Bank, we already have it actually. Okay. I'll show you later. WK. Okay. How often will this chart be updated? Every month. It won't change that much. Every day we update also, you will see no difference on. So every month we'll update it, or as and when there's a market crash, we'll update it. Okay, so that's what I think we can do. Every day, no difference. You see, last month, 2 months, 3 months ago, it's still the same, right? But 6 months ago, then it will be different. Okay, so here to here. All right. So because today you see 1 month, 2 months later, this number could be different already. Okay, so but as of now, it's still very useful, okay, because I just updated it today. Right. So now next one is. Yes, CK, we do have that chart for individual REITs, okay, but that again is achieved for our dividend machine pro member because it takes a lot more work to really go through those quality ones. So our professional member do have that access, okay. So yeah, okay. So question, some of you guys have submitted. Is it time to go aggressive on REITs as they have been beaten down for the past 2 3 years? Okay, so back to this, yeah. Past 2 3 years, REITs are attractive. Okay, so now if you ask me, I think you can really start to deploy into REITs, but you must know which one. If you don't have, obviously you need to go and find, right? Or you can join dividend machine, or Pro, even better. Okay, yeah. So don't just blindly go and buy. Richmond say REITs cheap. Go and buy every Tom and Harry style REITs out there. No, if you lose money, don't come and find me, okay? Because not every REITs can be investable, right? You need to be very, very selective, okay? So, but it's now one of the good time to buy, okay? But it's not a time where you show hand, okay? Not like what we saw with 2020, okay? So we adopt a wait and see strategy for REITs. If the yield is above 7%, would it be good to enter for a solid business REITs? I assume it's REITs, okay? So don't just invest based on you, okay? Like I say, you can't base on that. You need to look at the quality of the REITs, the location of the properties, the tenant, the will, the occupancy, the rent reversion. Those dividend machine member, you know what I mean. Okay, if you are not, there's a lot of things for you to learn. Okay, and this session would not be enough. Okay, just probably give you snippets of it. I know I don't have time to go through with you. Okay, it's really very big topic. I can spend a whole day with you talking about it. Right, and yeah, so dividend machine member, those of you who need a recap, we're gonna have live classes, webinar classes. This coming. Let me see the classes. Right. The earliest is going to be 22nd and 23rd. Okay, we're going to spend whole day with you. Okay, talking about REITs as well. Okay, so this is basically you can do a recap. Then I'm going to go through with you one more time if you like forgot about some of these terms. If there's a recession in the US, will REITs fall? Would it be a good timing to buy into the REITs? The REITs prices will drop if there's a crisis in the US. Not just REITs, every stock will drop. Will it be a good time to buy into REITs? Yes, best time if there's a crisis. Okay, but you don't know when. So it's a hypothetical question. So like I said, COVID 2020 is solid. All right, so that was like best time. All right, now it's good time. Okay, first tranche. Actually, there's also tranching strategy, which is another topic to talk about. Okay, I will share with you more. Okay, in the upcoming emails. Okay, where I actually recorded some of the training on how you can actually allocate your dividend or your portfolio. How do you go about deploying your capital if you are actually starting up? If you have $100,000, $200,000, or even $1 million, how do you go about it? Okay, so not in this session. Okay, so I will have a video for you upcoming, which I already recorded. Okay, so now again, another question is, what is the worst case scenario if REITs if the interest rate hover between 3 to 4% for 1 or 2 years? Can we assume the yield 4 to 6% in short term while waiting for the capital upside when interest rate fall? Okay, I already shared with you just now. I think you can still stay invested. All right, 3 to 4% is fine. Good quality REITs are actually raising the rate. All right, so I don't see an issue for them to continue to grow their DPU, maybe at a lower pace if not stable. All right, so but the yield should generally be attractive. If the price is right, why not? Okay, and do you foresee that the quality REITs are at their turning point? Yeah. Okay, because I expect rate to continue to drop this year. So quality REITs will shine. Okay, for dividend income REITs, should we focus on higher REITs? No. In fact, I already told you that if you focus on higher REITs, right, it can be a big problem for you. Okay, so I think let me show you. I think 2 years ago, a lot of people asked us, can invest in US office REITs or not? Wow, Manulife, 12%, 13%, right? Keppel, Pacific Oak, Prime US REITs, you see? Wow, all 12%, all the European REITs also, 9%, 10%. I told them, I got to be careful, man. If you are picking some of this REIT, you don't know what you're investing. Don't just look at the yield, okay? So you don't just look at the yield, all right? Yes, we do look at the yield, but caveats, right? And what we look at, healthcare, okay, if you did the REITs itself, they are subsector, if you are not aware. There are healthcare REITs, there are retail REITs, there are office REITs, there are industrial REITs, there are hospitality REITs, okay? Each one of these REITs, they have different characteristics, and when to invest in them, it's also going to be very subjective and dependent on the supply and demand and dynamics the industry that they're in. Okay, so you need to really take into account all this consideration. Okay, so don't just blindly look at the yield. Okay, that's the message for you tonight. Okay, just to keep it simple. So retail, more REITs versus office REITs. So these are all the big questions. If you are asking me, I can spend another 10, 20 minutes talking about all this. Right, but generally these are better to answer in a more like web class format, because I can go deep with you, okay, or even like a pre-recorded where I actually recorded I think close to 45 minutes to an hour talking about subsector in the dividend machine alone. Okay, if you are a dividend machine member, go and recap those topic. Okay, which type of risk can grow faster once the interest rate is cut? Okay, actually interest rate has very little to do with the growth of the REIT. Okay, generally it will apply to across the board because it affects the loan across all the properties, right? Whether it's residential, commercial, right? It will affect them, right? And how big do you see the threat of JB to Singapore retail REITs with the RTS? Okay, so the RTS basically is a train that is going to connect Singapore with Johor, right? So once it's completed, I think it's going to be completed, forecasted to be 2026, right? End of 2026. So 2027 could be the start of the the flow between Singaporean traveling to Johor at a much more convenient format, right? So so this is a question that everybody is actually asking, even to the REITs manager, right? How does it going to affect your malls, right? So the answer is, I think, okay, no one knows what is going to be impact. In fact, everybody is expecting. But from my experience, right, if I observe based on Shenzhen and Hong Kong, right? So Hong Kong is actually now, after the pandemic, a lot of Hong Kongers are actually, since last year, they were visiting, they are actually going to Shenzhen to shop. And you know how convenient it is to go to Hong Kong, from Hong Kong to Shenzhen. It's just a train ride. It could be like 30 minutes ride, right? And then you are at Shenzhen. And then you pass the custom. I think for Hong Kong, it will be a lot faster, right? At least for local, is even Chinese is even faster to cross the border, right? So it's very convenient and it doesn't take a lot of time. So a lot of Hong Kongers actually, they used to spend in Hong Kong during the lockdown, like 2021, 2022, and then 2023 when things started to open up. They started to go into Shenzhen to shop. So a lot of malls in Hong Kong were actually affected because of Hong Kongers not spending locally. They were actually going to Shenzhen to shop, right? So based on that, if RTS were to open and completed, and if the custom become more efficient, there's no snaking queue, people get passed through easily, right? People who stay in the north of Singapore, right, Woodlands, Sembawang, the area, they were more, I think going to be more inclined to travel to JB, right? If it's like very convenient, because things there are definitely much cheaper, right? So instead of going to Causeway Point, I'd rather go to City Square, and I can buy my supermarket things at like 30% cheaper as compared, or 50% cheaper as compared to Singapore. Why would I want to shop in mall in Singapore, right? So that could affect not just the mall landlord, it could also affect some supermarket players in Singapore like Sheng Siong or even cold storage. Okay, so the impact could be quite damaging for some of the company, but there could also be inflow, Johor people coming into Singapore. Whether they will spend a lot of money here in Singapore, that's a big question mark, right? And they may spend on more experiential things like going to sightseeing or whatever. Okay, so this is something that I think I'm observing very closely, right? And malls at the northern region, like those that belongs to Fraser's Interpoint Trust, I think if you're an investor of Fraser's Interpoint Trust, you have to monitor this, because Causeway Point, North Point, all these are closer to the northern side of Singapore. Those will have bigger impact versus those malls in the central area, or even in the southern area, or even the east side or west side, because it will take a long time to go to Johor. People generally want more convenience. They rather go to the neighborhood shopping mall, right? Suburban shopping mall nearby my house. I'll just go there. What for go for that, right? So then you have to queue for traffic, squeeze with people. Really, it's a hypothetical question now, but I am seeing that it could be a net negative impact for some of the retailers here, especially those in the northern side. Okay, but things might change. So I have to monitor, right, this very closely. Okay, so it depends on how Singapore will attract, or some malls actually going to ring fence their malls, right? They might have to introduce more brands that are not less affected by those people who are going to Shenzhen to do certain, going to Johor to do certain things. So based on Hong Kong, I think a lot of Hong Kongers are going for like massage, cheaper there. Doing their haircuts is a lot cheaper. Buying some groceries, right? So yeah, so those are some of the behavior that I'm seeing in Hong Kong and Shenzhen. Okay, so something to take note also. Will the demand for US office space recover, or is it going to permanently change because of work from home? Okay, will the demand for US offices recover, or is it permanently going to change because of work from home? So US office space has been beaten down for the last 4 years since the pandemic started. And there seems to be no way out. Although now there are some news that BlackRock is investing heavily in the office market because they are seeing recovery. And now Trump is asking people to go back to the office, right? So it looks like it's bottoming up. But I think there's still an oversupply issue there, okay? So I don't see there's going to be a sharp recovery like all of a sudden, and it's not going to be equal across the board. I think generally the core CBD area, those tier one city like your New York, all right, versus suburban office REITs, they are going to experience different type of recovery, right? So you're not going to see big recovery. So Manulife, they have like quite a lot of suburban office, right? I mean, it could be a grade A or trophy offices. I don't see they're going to benefit much as compared to those that are more central, like your New York or San Francisco, where the supply generally are a lot tighter over there. Okay, so it depends on what REITs we are talking about, but it's not a sector that I will personally touch. Okay, even though now people are saying, "Oh, US office going to recover, it's time to go back in." Okay, if you study the supply and demand dynamics, there is still oversupply. Okay, same thing. Yeah, so yeah, there's a lot of talk I can share with you, but I think I better get going because I still have, oh my God, 30 over slides to go. I'm just halfway there. Okay, so what is the outlook for India market? CapitaLand India, China. Capital India Trust. That is not a REIT. Okay, so generally I don't bother. Rupee depreciate against Sing dollar. Right, it's a net negative overall. If they can keep raising the rental, but your rupee keep depreciating against Singapore dollar, to me, it's emerging country, the risk is too big to take. Right, so I'd rather stay in Singapore. If you're Malaysian, stay in Malaysia. Okay, and welcome to Singapore. Right, I always tell the real machine member, come to Singapore to invest because you have better quality REITs and you have data center REITs, which is also a topic that I can spend a long time. Okay, so yeah, it's a big topic. This is a Durian Machine course. Okay, for DM member, just go and review it if you need to. And we're gonna have web classes coming up in 2 weeks' time. Okay, so you register yourself if you want to. If not, you can register for the March training session also. Okay, it's going to be on weekend as well. Okay, for new members, all right, if you want to join on the 10th of Feb, okay, you cannot sign up now. But yeah, 10th Feb is going to be this coming Monday. Okay, so Hong Kong and Singapore REITs. Okay. Actually, I have shown you some of the slides, okay, but I didn't show you. Yeah, so these are some of the questions that I read up. Yeah, that I read up previously, okay, which you didn't get to see. All right, and yeah, so between Hong Kong and Singapore, which one would be better focused in the current environment? Right. So now, if you look at the Hong Kong REITs chart, okay, so this is also the chart that I will also put up on the Dividend Machine portal, okay. So you will be able to see it by hopefully next Monday. Okay. Yeah. So this is the current valuation price to book of the Hong Kong REIT. So you get to see that it's very, very depressed. It's like horrible. Right. So that kind of shows you how bad China Hong Kong market is right now because of the current ongoing property crisis that we are seeing in China and Hong Kong. Okay, and Hong Kong actually started during the riot, right? Second half of 2019, and then it just get worse. COVID came in, lockdown 2 years was horrible, right? And then started to open up, and then this last year was seeing a good recovery, but because property sector is still very weak, and the whole sector is just down. Okay, so Hong Kong is also very cheap. Even cheaper than Singapore, even cheaper than 0809. Okay, times to look at Hong Kong REITs. Okay, so I think that's what I can tell you. Okay, between Hong Kong and SGG, which one is a better focus in the current environment? Hong Kong is cheap, but not a lot of choices over there. Okay, Singapore got more choices. Right? Would you like to understand Hong Kong economy outlook? Any Hong Kong REITs worth studying other than Ring REITs? Generally, I have not gone through some of it. Hui Hsin REITs is not a good REITs also, okay? But there are only a few options, okay? So I don't think there's much options over there in Hong Kong REITs market other than Link REITs itself, okay? How do you see Link REITs in Hong Kong given the trend of Hong Kong people shopping and spending in Shenzhen, okay? So I answered this question, and I think that Link REITs might do a lot better as compared to other malls because generally their malls are more suburban. they have some malls that are being affected, but they also have mall in Shenzhen, okay, which benefiting from it. Okay, but about it is still in Hong Kong, right? So now people are very cautious about generally the retail REITs in Hong Kong because of the Hong Kong going to Shenzhen to shop. Okay, so it also depends on the currency. You see, if Sing dollar strengthen against Johor, you think people are going to shop at Johor more because it's just to save that 10-20%, you know, and then they commute all the way to Johor to do the grocery? I don't think so, right? But if the currency strengthen against Johor or ringgit, then people may be encouraged. Okay, and that has been the case in Hong Kong because yen weakens against Hong Kong dollar. So generally, people are going to Shenzhen Mall to shop. Okay, and this trend actually has been ongoing even before COVID. Right, it's just that recently yen is a lot weaker as compared to Hong Kong dollar. That's why people are more inclined to it. So it's like could be a bit of seasonal, right? You will still have people, but you won't see everyone just go Shenzhen to shop, right? Same thing, you won't see everyone going to shop. Okay, maybe you have increasing percentage of people going to shop like once a week or once every month like that. Okay, but most day-to-day stuff, people will still shop their things in the community malls. Okay, just to put it that way. Okay, so I think REITs will still it will still have some impact over there, but generally their occupancy cost is still quite low, right? So they should be able to absorb some of it. Okay, if you don't know what is occupancy cost, recap on the modules. Okay, so how would the REITs and interest rate affect Malaysia and Hong Kong? Yeah, so Hong Kong is very pegged their interest rate closely to Fed rate. So whatever that Fed goes up and down, it will affect them, right? So Hong Kong is really in a tough market because first, their property market not doing well. Second, borrowing cost is at all-time high in 2023 and now has been coming down, okay, which is a bit of relief lah, okay. And could you please touch on the Malaysia REITs as well? Okay, didn't talk a lot about Malaysia REITs, but if you look at Malaysia REITs index, actually, for 2021, 2022, 2023, right, we have been telling our dividend machine member time to look at. If you are Malaysian, time to look at Malaysia REITs, especially 2022 here and here. Very cheap. A lot of retail REITs are very cheap. Time to buy. So I hope some of you guys bought. Okay. If you are a dividend machine member from Malaysia side, if you bought some of the retail REITs over there, just type me. All right. Today you'll be happy because a lot of them have gone up. Okay, so yeah, but generally I think Malaysia REITs have recovered almost back to the pre-pandemic level lah. Okay, so 2019 level. Right, still not fully recovered yet. It's about 10% below, but on track. Okay, it's not as bad as compared to Singapore. Okay, generally they are doing a lot better. So opportunities now are lesser as compared to Singapore and Hong Kong. Okay, so if you attend this year dividend machine, I'll tell you, Malaysia side not as many opportunities anymore, not as attractive. Okay, so David, congratulations. Okay, then for Singapore listed US offices, do you think there will be potential upside in view that US mandated back to office for federal employees? I already shared my opinion, so I'm not going to repeat it here. I have Manulife at 90% loss. I'm sorry. 90% loss. That is very painful, you know. Whole or cut loss if interest rate might go up. I also don't know. Because you bought it at the wrong price and it so happened that you get caught at the COVID sell down and the trend to work from home increase, I would say you're very suay lah. Okay, actually, we also bought Manulife. Okay, but we made money. Okay, how come we made money? You may ask. Okay, first we bought during COVID, so we bought at a very good price. Second, we sold it before things get worse, and that was I think in 2022, where the rate were hiking. Okay. And there was a trend that is not going to reverse, which is the work from home. Okay, so we saw it. And third, thankfully also the REITs the Manulife, the management went back to their words because they went to acquire one property which wasn't MPI yield accretive or property yield accretive. So there was a red flag that we caught. So we sold it off. We made a slight profit. Okay, we actually could have made more if we sold it. Right, it's just that they came down and then they did the acquisition. We decided to call it off. Right, if we were to keep Manulife until today, we have lose 70-60%. Right, so sometimes you must know when to get out also. Right, so there are sometimes REITs fundamental may change, so you need to know when is the time to get out as well. Okay, but for your case, you got it at the wrong time, you get caught in the trend. I personally will cut loss lah. Yeah, so because for the whole office sector to recover in the US, it's going to take a long time. Okay, so I rather take the money and invest in REITs where there is a high quality one, right, and it can revert very quickly, right, in the next couple of years. Manulife, I think it may take a long time, right? So I don't know whether they will survive actually, okay? Because they have been always on the verge of like liquidation. They have to sell their property to pay down the debt, which is, it's not an ideal stage to be in, okay? But I'm sorry to hear that you had a loss of Manulife, okay? I don't know who you are because I don't have the name when I received the question, okay? I hope it's not your only position. It's just a small part of your investment. Okay, that's why diversification is also important, which we covered in the dividend machine as well. Okay, which other country REITs can I look into beyond Singapore, Malaysia, Hong Kong, and US? Okay. So my question is, why do you want to go to outside of Singapore? If you are Singaporean, look at the currency. Singapore appreciated against major currency, for the last 24 years. Okay, these are all the data that I have compiled last year. Okay, look, Sing dollar is so strong. Right? If you are Malaysian, if you invest in Singapore, congratulations, you will be making a lot of money also from currency appreciation. Right? In rupee, like I said, you see, wow, 180%. Horrible. Sorry, I'm blocking it. But that's India. Okay? Why invest in Ascender's India Trust? That's my question. You are fighting against the wave. Go with the wave direction, not against the wave. Okay? I hope that answers your question. Preferably stay in Singapore. Okay, that's my better option. If not, stay in developed market. Okay, Europe, US, but stick to industry that have a very healthy supply and demand dynamics. Okay, and that is a big topic to talk about. Okay, so and I'll leave it for another day. Okay, Singapore REITs also have investment asset in other countries like Hong Kong, Australia. What is the outlook of these overseas REITs? Long question, long answer. Okay, I cannot answer this in just 1 to 2 minutes. Okay, yeah, but generally for Mapletree Pan Asia, which have assets in Hong Kong, like Festival Walk, that asset is having a lot of pressure because of the Hong Konger going to Shenzhen to shop. So they are actually seeing their tenant sales recovery not as quick, as fast as what they would expect. Okay, so if it doesn't get worse from now, okay, they should be able to maintain that rental income, the MPF from their Hong Kong asset. So hopefully it doesn't drag down their asset because financing cost is coming down in Hong Kong. So that will affect, that should not put on extra pressure on them, right? But of course they do have other assets in Japan, which didn't do well. It's a big surprise last year, all right? So, and again, those are a small portion. A big part is still like in Singapore, like 60%. So generally I would expect that their DPU to either continue to drop at low single digit, if not stabilize by 2025. Okay, so that again depends on the interest rate movement. If it drops further, then obviously the recovery will be a lot faster, right? So now because of the Fed pausing the rate, obviously now the thing will just drag. Okay. Could you explain why Mapletree Pan Asia is dropping? Will it go up soon? Good time to buy more? I already covered this in the few round tables. You can go and watch, right? And I already shared briefly just now my answer. So yeah, Keppel seized the dividend since 2024, losing half the listing price. What happened? I already talked about US office REITs quite a lot, and big reason is because of the work from home and oversupply situation in the US, and also the interest rate that is quite high for them. Okay, and falling property prices, which I explained earlier in the slide where I explained how interest rate will affect the REITs. Okay, Singapore listed US offices. Do you think there will be potential upside in view of the US mandate back to office for federal employee? Okay, I already answered this question already, right? So how will data center REITs be affected by DeepSeek AI? Good or bad implication? Okay, is it time over for traditional data center REITs? Are you bullish or bearish on Capital DC, Level 3 Industrial REITs? All right. Okay, so I'm not going to answer this question. Okay, I'm going to answer this question in the next couple of weeks. Okay, where I'm going to find out more data. Okay, because this one's going to take time to answer it, and then we're going to release a roundtable on this. Okay, so do watch out for this topic. Okay, on our YouTube, our email. We will basically send out the email to you guys. Okay, where I will answer more in depth answer on this question. Okay, you guys have a lot of questions. Actually, I received a lot of questions about this. So I thought it's good to have like roundtable, which I think it easily take at least 20 to 30 minutes to answer this question. Okay, so I will have more data for you guys to show. Okay, but for this session, it's getting a little bit long, okay, because you guys have a lot of good questions, okay, which is good. And the purpose of this live webinar is to answer as many questions as you guys have. Okay, so stay tuned for the answer for this. Okay, is it good time to add more quality REITs, especially when the prices are depressed? Yes. Okay, I like this type of generic question because I can give you a generic answer. Do you ensure the property yield is above the debt or cost when selecting the REIT? Yes, at least 1%. Okay, if you don't know what I'm talking about, please re-attend the live webinar. Okay, which is going to happen next 2 weeks time. Okay, where I talk to you, I tell you guys I need to have at least 1% spread. Yeah. So what metrics of the indicators should I focus on determine if the particular REIT is well positioned to handle the changes in the interest rate? Interest cover, gain ratio. These are the two important metrics that we look at. And then, of course, the borrowing cost, the percentage of fixed loan, floating loans, and many more. Property yield, cost of debt, many more. Okay, so yeah, very, very important. I think I still have a few videos coming up to teach you guys some of the key metrics that we looked at. All right, so do watch out for the video. See, we have a lot of things planned for you, right? If you have not really catch up or if you are starting to learn, okay, so I'm excited for you guys actually. Okay, so if you are really ready to learn how to invest, okay, if you already learn how to invest, then watch our roundtable or our email. So what is the best method to determine the intrinsic value for REITs? There are many valuation metrics. Replacement cost, price to book is one of the metrics that we use quite often. Yield is also one of the methods that we use to check whether the REIT is undervalued or not. Okay, so how to choose the REITs with higher proportion, higher potential for cap growth, yet provide decent dividend yield. Wow, this one, another day to answer. Okay, yeah. So when choosing a REIT, should we be more concerned about the type and the location of properties rather than interest rate? Yes. Okay, so we do focus a lot on quality of the REITs, and how do you go about finding those REITs with good quality? And I will basically show you how to find that information in the dividend machine. But here again, I'm sorry, but I had lack of time. Now I don't have time, okay, because we're going to end this at 10. And I only have 20 minutes to answer the question that you guys might have outside of this, okay? So I will just quickly go through with you some of the slides. Almost done already. Then I will open the question to all of you guys who are attending this live, okay, to be fair, because you guys are tuning in live, okay, for this session. When will the research back? Wow, I love this question, okay? Can you guys tell this? Can you guys answer this question, okay, because I don't know how, okay? David, William, Ming Hui, if you are watching this, can you help me answer this question? Help me, because I have answered a lot of questions, okay? When will the research back? Okay, if you guys know the answer, let me know. Okay, I don't know the answer. Okay, given that the expected rate cut in the US are slowing down, how would will impact the Singapore interest rate? Okay, so generally interest rates are also coming down in the Singapore because it pegged very closely to the US side. So now right now the floating rate for interest rate is about 2.5, 2.6, 2.7 if you are in the residential market. Commercial maybe at a slightly higher side, it could be like 2.8 or 3% or slightly higher, right? So it's lower as compared to last year. So if rate continue to come down, obviously Singapore will follow. Okay. Other than REITs, Singapore Bank. Singapore Bank, another big topic. Is it a good dividend stock under the current interest rate environment? Actually, with the rate coming down slowly and now plateauing, it's still good for the Singapore Bank because now Singapore Bank can adjust their loan, okay, because they have like agreement with their borrowers, right? And then they can slowly adjust it. So the impact will not be as much. And then with falling rate, obviously you encourage people to buy more properties, and that may push up the quantum. And on top of that, the wealth management side for Singapore Bank are also doing very well, right? Because Singapore generally is a financial hub, is actually attracting a lot of flow of money into the country, and obviously all this money will go to the big three banks. Okay, so I think banks should continue to pay very good dividend as long as interest rate does not fall off the cliff. Okay, so that's something to bear in mind. Okay, during the coming period, is it better to invest into Singapore banks that gives 5% yield as compared to the REITs, which have 90% payout? Okay, you must understand that why bank cannot pay out more than 90% is because of the regulatory limit that they have. Okay, so every time they grow, they need to put in more money in the bank. Okay, to make sure that their capital adequacy ratio is still within the regulatory framework. That's why they cannot pay 100%. Not that they don't want to, but they cannot. So their payout ratio always at 50, percent benchmark there about. Then they will preserve some capital, right? And the rest, then they will put it as a regulatory requirement. The REIT, on the other hand, is different. They can pay out 90% because they need to get exempted from tax. They have to pay out more than 90%, right? So in terms of valuation, obviously bank is cheaper, if you ask me, right? But you don't think that they will ever go to 90% payout. It won't happen. At most, they will give you special dividend every now and then, but they will not go to 90% payout. So there will not be a bonus like higher payout or higher dividend over time, right? So if you ask me whether banks, is it a good time to buy now? Back to the valuation, right? So now, if you go to just now earlier on, some of you asked, okay, do we provide the price to book chart, which is the metric that we use for bank in the dividend machine? The answer is yes. Some of you may not be aware, but let me show you. It's already okay. Sorry. Okay, let me go to, because my screen got locked out. Because too long, I see. Okay, if you go to this dividend machine, okay, so this is a portal where you're logged in to do all these things, right? So you go to Singapore Bank. We cover quite a lot of topics, right? Singapore Bank, Malaysia Bank, REITs, Malaysia REITs. But you go to, just to show you where is the price to book chart for Singapore Bank, including the OCBC DBS, right? Actually, you get to see Victor update this manually every month, It's right directly under the valuation column. Where is it? Okay, it's not loading, but it's somewhere around here. Okay, so if I were to show you the slides here, yeah, it's under the bank valuation, price to book. It should be able to, once you logged in, once it load, you get to see the latest one. This is the latest one that I just took a screenshot. As of 1st of Feb, you get to see DBS, OCBC, and then UOB as well. Okay, and then you know whether they are expensive or cheap right now. But the short answer is they are expensive right now. Okay, so and this chart will be updated every month together with the REITs price to book. Generally, so we will put the REITs part under the valuation module. Okay, so at least you guys get to see where we are in the cycles. Okay, So I hope that is useful for you guys. Okay, please log in to the dividend machine more regularly. Okay, so even if you already completed the modules, the live training, right, or even our professional members, right? So now let's come back to the portfolio. So some of you asked about how do you allocate, okay? So I'm not going to go into this because I prepared also another video on how do you diversify your portfolio, right? In the upcoming email, just watch out for it. I have a special training for you guys, pre-recorded, where I talk about how do you diversify, how do you invest your REITs, right? How do you manage your portfolio, how do you reduce your portfolio, okay? So in this uncertain situation, will buying REITs ETF be better than picking individual REITs? Right, so I've received a lot of questions about buying ETF REITs. Okay, actually, if you look at the available REITs ETF, this is the table is compiled by Stashaway. I took a screenshot and I put it there here. I thought just so that I don't have to go and compile myself. So if you look at all the REITs here, basically if you invest in REITs ETF, yes, you will still get this kind of yield. Okay, but note that the performance that you're going to get from this REITs ETF may not be as fantastic. Okay, you may not get the actual yield over time because you must remember that you are also paying the ETF 0.6% a year just to have that diversified portfolio, right? So they may have holdings that you may not like in the portfolio. Okay, if you don't know how to pick REITs, obviously you'll be okay with it because you don't know which one is good, which one is bad. But for our dividend machine member, I don't want this one. But if you invest in ETF, you will come with it. Okay, so generally, if you are a dividend machine member, I will tell you guys avoid S3 ETF. Just go straight to those REITs that you like, invest in them, diversify across different subsectors. You are good. You are better than the REITs ETF, and you don't have to pay the expense ratio. 0.6% doesn't seem like a lot, but actually it adds up over time. Okay, and then some of them are like not just investing in. Only two there's pure Singapore, and they are very small. They see that AUM is 300 million. They don't have the scale. And this one is even worse. They are slightly better. I don't know whether it's better or not, but their expense ratio, I remember was actually lower. Okay, but never mind. They are still very small. Basically, it's 300 million range. So actually ETF, if it's below 1 billion, generally I don't look at them because illiquid and then you don't know whether they can sustain themselves or not, right? So, and on top of that, you have to pay this expense ratio at 0.6 to 0.5%. But the good thing is, of course, you have diversified portfolio, and then if there's any right issuance, the ETF will do for you. It's not difficult to have the right issuance. Generally, if you invest in quality REITs, you should not have right issuance. Okay, so yeah. So if you don't have choice, if you are lazy to learn how to invest, then go for REITs ETF. Okay, if you still want to have exposure in REITs. Okay, I don't know whether I answered the question, but I think I answered. DCA versus lump sum, should I start DCA on REITs ETF? Okay, if you don't know how to invest, if you don't know what REITs is, then you can do a lump sum. No, DCA. If you know how to invest, if you have the price to book chart that I showed you earlier on, you do lump sum better. So when the valuation is high, you stop or slow down your purchases. If the valuation is cheap like now, you whack, okay, because your return will be better as compared to if you are just doing DCA. All right, DCA will be very good every month. If you are investing in US market like Spider ETF, right, SPY or VWA, because generally gold stock, they will keep going higher and higher. Even after crisis, they might even go higher once a bull cycle go up. All right, so DCA might be a better strategy there. Right, and then okay, is it better? Oh, I still haven't finished my question. Okay, last slide, last two slides, and then I will go to some of the questions that you guys may have. Okay, is it better to invest in individual high quality with strong management or REITs ETF for diversification? We only invest in high quality REITs with strong management. All right, we don't invest in REIT ETF. All right, like I said, if you don't know, then REIT ETF might be a good option if you still want to have a REIT ETF. I've been buying REIT ETF thinking that it is safe, but suffer capital loss of 20%. But should I continue to hold? Yeah. So I just said, right, in REIT ETF, you might lose capital if you enter the wrong cycle. Should I continue to hold? If you know how to invest, cut lah, right? And then pick the better REITs so that you can appreciate. If you don't know, then just dollar cost averaging down. Okay, so very hard for me to give you the precise answer because I don't know you. Okay, there are so many of you here in this room, so I really hard to give you a general answer. But my best answer is pick quality REITs, stay with them. Not only they're going to grow your capital, but they're also going to grow your dividends. I mean, that has been our style, right? It's not difficult to learn. Okay, it just takes time. It may be overwhelming at the start, but if you do it for 1, 2 years, 3 years, you'll get better over time. Okay. REITs versus bond in today's market environment, which is better in investment instrument? I still prefer REITs. Right, bonds is a lot safer, but again, depend on what type of bonds that you invest. Corporate bond, company, right? And to do that, you need to learn how to analyze a company, how to read the financial statement. By hook or by crook, I tell you, you have to learn how to invest, all right? Otherwise, you have to get fund managers, right? And some fund managers may not know how to invest also. Okay, you'll be surprised. And then some FA, they may outsource it or they may just throw your money into an ETF, right? So I always think that it's good to have financial knowledge, which is why I believe most of you here because you want to learn how to invest or you are actually working on how to become a better investor, which is good. All right, keep doing it, keep watching roundtables, a Q&A segment. We have live webinar, please attend, right? And if you want to speed up, we have a course for you, all right, which will help you to give you a system that you can implement it right away, right? But at the end of the day, I think most investor, if you are managing your own money, your family money, if you are planning for retirement, I think investing is a necessary skill to have. Okay, at the end of the day, okay, it's not difficult, right? And T-bill and REITs, which one is better? 2025, 2026. REITs is better. T-bill is safer, for sure, but your upside is limited. REITs have more upsides. Okay, so let me answer some live question. I'm sorry I take longer than expected. I thought that I would take 1 hour to go through the slide and then 1 hour Q&A with you. But then I didn't expect that. Actually, there were a lot of questions that were already pre-submitted. You know why I come up with 1 hour? Because I have 65 slides. I have 5 to 9. So usually, if you're a presenter, one slide average is about 1 minute. But then I forgot that one slide I have 2, 3 questions. So that actually took longer than expected. Okay, so my bad. But I hope I answered a lot of your questions tonight. And if I have not answered your question, type them in the question right now. I will pick some of the questions that I can answer, for the rest of the session tonight. If I cannot answer, don't worry. All right. You can still attend the next live webinar, which we will still have. Or if you're a Dividend Machine member, you can still drop your questions for us, right? 24/7, we'll be there for you. Okay? Those members, we have been answering all your questions since 2015, every day, right? So, and I'm still the one that doing the answering, okay? Occasionally I will still get my team to help if they are better with certain companies that they cover. Because I don't know a lot of companies. I don't know all the companies, right? I only know companies that I'm familiar with. Those that I'm not familiar, and Victor cover, Victor answer. If Joy, who is our full-time analyst, he will then answer. Right? Is it time to go somewhere REITs? David, congratulations. You must have make money. Look at the plot, the price to book chart that I showed you earlier on, and see whether they are at the higher side. If they are on the higher side, you can start to do your partial divestment because you already make money. On top of that, you have collected good dividends if you invested since last 2 years, right? So yeah, that's my answer to you. Because I don't have the chart right now, I need to refer back to the chart. Okay, let me take a look now. Because I want to give you an answer, so give me a while. It's not loading. Just like I always go back to the chart that we have. Okay, if you are a pro member, you can just go in and see yourself. I don't know why our website is not loading. I think it could be because a lot of you guys are accessing the website. Eh? So no answer for you, David. But I think it's either on average side valuation or higher compared to last year. Okay, because I saw it just not too long ago. It has gone up quite a little bit. Okay. Um. Okay. Other question. Uh. Mm, so, maybe can okay. No question. Very interesting. Should we buy Hong Kong REITs? Yes. If you know which one to invest. Okay. Any other question? Okay, if you don't have, I think actually I answered a lot of your question, right? Because those are the questions that a lot of you guys have today in mind. Okay, I didn't answer some of the questions like the data center REITs because I have a separate session for that. Diverse portfolio side also. I have another video for you also, which will be coming. So do look out for it. CH asks, which MI REITs has strong presence in JB? Most of the Malaysia REITs have strong presence in KL. Mid Valley, Mega Mall, IGB REITs, I'm not sure whether they own the Johor side. Okay, I've got to confirm with my Malaysia team, okay, because they're more familiar with Malaysia REIT. But generally, the way I see it, KL CC REITs, they are primary in KL. Most of the Malaysia REITs, they are most concentrated in KL actually. Okay, some are in Penang, some are in like yeah, most of them are in the area lah. Okay, so yeah, there is no specific that have exposure in JOAB. Okay, so other question: how is iREIT global with majority of the properties in Europe? Hai Song asks. To be honest, I have a lot of questions on European REITs over the last few years. And I always tell them I don't know. Because the supply and demand dynamic in Europe is very different at each state. Netherlands have their own supply and demand dynamics. And you know, Europe's is like Asia, Indonesia, Malaysia, you know, there are so many countries there. And this REITs, they have like different exposure in different market. And for me to follow them, it's going to be very difficult because I have to go and study property that they have in those market and to check whether they are oversupply or not, right? Or in the tight market situation, right? And it's too difficult. It's going to take a long time, and I decided that look, stay in Singapore, lah. Right? You have Singapore REITs, that you can choose, and not that European REITs. European REITs are cheap, okay, for sure. But whether they're going to do well, I don't know. And there's a currency headwind, right? Which I think Euro might be a lot of pressure, especially if Trump is going to impose tariff on them as well, right? So I just think that it's a lot safer to come back to Singapore, right? Because you have better fundamental. Singapore market, property markets are a lot stronger. Office, retail, right? Hospitality also, data centers, they're very strong. Okay, and I like it because Singapore has limited land. Right, when you invest in property, remember supply and demand. Right, and if you have a tight supply, that's the market where you want to be in. Okay, would there be replay available tomorrow? I think there should be a replay available for you guys. I'm not sure actually. I have to check with my team, but it should be a replay. Right. Can you email in and ask? Usually we have replay okay, because you can go and watch again. Because especially if you missed out. What is your thought on AIMS APAC REIT? Is it a well-run REIT? This AIMS APAC REIT, you have to go and follow AK. AK follow very closely. I think it's a decent REIT. They have done pretty well ever since George Frank took over. It's an industrial REIT. Just that I did not follow it closely. AK follow very closely on AIMS APAC. We go to his blog and bug him. Okay, don't come and ask me. He's very good. He even went to visit a lot of the properties there because the management invited him. Okay, so go and ask AK. Don't ask me. But I think it's a decent REIT. Okay, Hong Kong may be on a permanent downtrend. Why do you think Hong Kong REITs will recover? It may be permanent damage. YK asked this question. Okay, so given that the valuation is all-time low, I think Hong Kong REITs, if you pick the good one, okay, it will still do well. Okay, if there are a few things that government is doing. They are trying to revive the economy. What is China is doing? If China managed to revive the economy, and they're also reviving the properties. They are releasing all the cooling measure, lifting up all the cooling measure. And usually when this cooling measure started to go up and the property prices is very depressed, that's one of the best time to actually start to go into the market. And the good thing is that the Chinese government have full control, with the supply side. And they had made the mistake of giving out too much supply. They didn't expect that the whole macroeconomic situation to be like suddenly on a downtrend, for the last, since China Evergrande crisis, so the last 3 years. And now they are doing whatever it takes to revive the property market, because if they don't revive the property market, the consumer spending might not be able to recover. Okay, so China is doing whatever it takes to revive it. And I think chances are very high that they will pull it off. It will take time, because property doesn't recover just within like change of policy, like within the year or so. It takes time. It takes time for government to convince everyone that it's the time to invest in property now. Property prices start to go up, and then the things start to flow. Just like Singapore, Everybody believes that invest in Singapore property market will make money. So because everybody now believe it, that's why it's become a very sustainable or very solid fundamental for Singapore government. They're not going to crash it. Even if they introduce cooling measure, they will do it slow and progressively. But the next time when Singapore lift up the cooling measure, remember it's time to invest in Singapore property market. Because government in full control, and China also have full control in interest rate. They have been lowering the interest rate since COVID. Unlike US, they have raised the rate, but China has been reducing the interest rate. So they have full control, over their currency, over their interest rate. So I think it takes time for sure, but bottom is more or less what we are seeing right now. Things are improving, especially after the stimulus late last year. Although it seems like dying off, but I would expect that they will still continue to do a lot of policy to revive the market. And if the property market come back up, then you will see trends start to reverse, The investor will start to come back. And so, like I said, in the bear market, everybody's so scared. And that's precisely the time where you should be in. You don't want to go in blindly. Rismin say good, better go in. Selective. You don't want to go in and then anyhow hantam or anyhow invest. No, be selective, pick the good one. The yield is like 8%. I can tell you the good one is the yield is 8%. Stay invested. Enjoy your dividend. All right. And then when the sentiment come back, 3 years later, 5 years later, we will come back and talk about this again. And I'm curious also, how is it? Because now we have investment not just in REITs in Hong Kong, but also property in Hong Kong and China as well. And we pick them at a very good price. All right. So timing is everything, right? So so that's my answer to that question. So what other question that you guys may have? It looks like not much. I think we are already past 10:04. I think that's pretty much it. I hope you guys enjoy tonight's session, and I hope I answer your question. And if you do enjoy tonight's session, let me know in the chat, so we can plan for more sessions like this with you guys in the future. And then so that you guys have chance to ask your burning question. And these are the kind of live session that I think a lot of you guys will appreciate. But let me know if you enjoy session tonight. And Yeah, thanks for tuning in. Thanks for spending 2 hours with me talking about investing. I hope you guys learn a lot of things. Okay, because even by answering some of this question, I personally also learn from them as well. Okay, yeah. So let me know in the chat. Yeah, okay. So pretty much that's it lah. Okay, so thank you so much. Right. Um, Okay, and happy Chinese New Year. And of course, happy holidays last week. Okay, I mean, it's over now. I think we are back pretty much back to work. But have a good evening, and I hope the rest of the year you guys will have a fantastic, um, uh, uh, investment result. Okay, hopefully, things get better by end of the year again, and then we all of us are what again. Okay, so a lot of you private message me. Why? Is it because I mute? I can only allow private message. Yeah, I think I accidentally click private message. Yeah, but thank you so much, everyone. I don't know how to change back to your messages, but I can see a lot of you guys saying thank you. Right. So yeah. Okay. Bye bye. Cheers. Have a good evening. Okay. Thank you.